Welcome and hello. In this chapter we'll be going through itemized deductions. These are deductions from AGI for those who itemize our deductions. We'll also be showing you a few of the websites that support Chapter 5, as well as running through some of the connect problems that you'll be facing this week. So let's get started. The common deduction from AGI are medical expenses, and for 2019, any medical expenses that exceeds 7.5% of your adjusted gross income are deductible by your spouse, yourself, or your dependents. Just about all the medical expenses are deducted as long as they're doctor prescribed. However, it does not include expenses such as being a member of a health club. Maintenance-related expenses, or those designed to maintain one's health, are not deductible. Any medical or capital expenditures, such as building a ramp to accommodate a wheelchair for your home, is deductible to the extent that it does not increase the fair market value of the property. Any transportation costs, such as conveying someone to and from a medical care facility, are deductible as well, as are premiums for long-term care insurance. These premiums are indexed to the taxpayer's age, and generally the older you are, the greater is your deduction for long-term care insurance, because presumably your rates would be higher as you get older. Just to go back to this top capital expenditure deduction, I should also mention that the reason that the medical capital expenditures, like as I said before, one example is building a ramp for a wheelchair, is that if it increases the fair market value of your property, you will get that back when you sell the property, presumably. So any medical expenses that are incurred of a capital nature that do not increase the fair market value of your property are deductible. Deductibility of state and local taxes is a pretty common deduction for those who itemize on Schedule A. And of course, this includes foreign taxes, local taxes, and real estate taxes. A new change that limits the deductibility of state and local taxes is now $10,000. That's a considerable change for those who are relying on large, for example, state and local tax deductions that exceeded $10,000 in the past. Now the limit is $10,000. $5,000 for married filing separately, so there's a little bit of a penalty there for married filing separately. So the real estate taxes are deductible in this federal taxable income calculation. So the real estate tax would relate to real estate used on your personal residence. And personal property taxes paid for personal use assets, such as your family car, are deductible on Schedule A. And the tax, for example, if you used to be in the state of Minnesota, you had to pay a tax that was based on the value of your car. That would qualify as a personal property tax. If it's imposed on an annual basis, such as a $75 fee, then generally those costs are not deductible. But if it's based on the value of the property, personal property, then you may deduct them on Schedule A. Taxpayer can deduct the amount of state taxes actually paid. So we know that most taxpayers are on a cash basis. So when you pay the taxes, that's the year you can deduct them. If, however, you do itemize the previous year and you took a deduction for state income taxes and then you got a refund the following year, according to the tax benefit rule, to the extent that you received a refund, that refund would be included, or at least part of it would be included in taxable income the following year, because you got a deduction the previous year and then you got some of that back. So there's a calculation here that limits the amount you'd have to report based on the incremental increase over your standard deduction. But for our purposes at this point, it's enough to know that if you itemized the previous year and you deducted your state income taxes and you subsequently received a refund, part or all of that refund may have to be reported as income the following year. So Another deduction is for state and local taxes. So if you either have state or local income taxes, or you paid state sales taxes, you can deduct either of the two. If you live in a state where you do have a state income tax, generally you're better off deducting the state income tax rather than the sales tax. You cannot do both. But if you live in a state that does not have a state income tax, then you can deduct your state sales tax if you're itemizing. As a matter of fact, the IRS has a calculator that we can use to calculate the amount of our sales tax deduction if we are going to deduct sales tax. So there is a sales tax calculator by the IRS website that we would follow the instructions with and just fill in the amounts as we proceed based on income and family size, etc. Again, most taxpayers who pay state income tax would just deduct the state income tax on Schedule A. As I said, you can use this calculator I just showed you, or there are some sales tax tables you can use to determine how much of your sales tax you can deduct if you decide to go that route. One thing to note is that when you pay foreign taxes to, for example, a foreign country, you have the option of either taking a credit for the foreign taxes paid or deducting the taxes paid on Schedule A. Generally, a credit is generally more valuable to you than a deduction. And we can kind of show that in a little Excel spreadsheet that we have here. Let me get this up for you. I'm going to make that a little bit bigger. All right, well, let's take a look at this example. Here we have comparing a deduction to a credit for the same $2,000. If you take it as a deduction, and let's say you're in the 22% tax bracket, then the cash value of this deduction is only $440. So yes, it's a $2,000 deduction, but its cash value to you is only $440. However, if you take it in the form of a credit, then it is a dollar for dollar reduction. And so you'd be able to deduct the entire $2,000 subject to refundable limitations, and we'll talk about those in Chapter 9. So there are some limitations on the amount of a credit that is refundable. But at least it's worth knowing at this point that a credit is a dollar for dollar reduction in your tax obligation. A deduction is only worth the deduction times your marginal tax rate. Now, if you have interest on a loan that was used to buy your home, or interest on debt that was acquired to improve your home, such as a home equity loan, then you can deduct the interest on that debt up to $750,000 of debt. So in other words, the loan cannot be greater than $750,000, but then all the interest on that $750,000 principal amount is deductible on Schedule A. There is a unique nuance here that kind of rewards people who own a home together but are unmarried. And it's this: if an unmarried couple owns a home, then they each get the $750 principal limitation. So potentially, they could take out a loan and borrow $1.5 million, which is $750,000 times 2, and then all the interest on that debt that they pay would be deductible on Schedule A. Because this is on a per taxpayer basis, not on a per residence basis. And here we have an unmarried couple, that's 2 taxpayers. They each get the $750 if they own the home together. And this would also apply on any home equity interest. If you pay points on the mortgage loan, a point is 1% of their loan principal. So for example, Marissa pays 2 points on a $100,000 mortgage loan. 2% of $100,000 is $2,000. So she can deduct that ratably over the term of the loan. However, there is an exception that allows for the deduction on the front end of the loan if a loan is used to purchase the principal residence. Another common deductible item on Schedule A are gifts to charity. And generally, a taxpayer can deduct either 60%, 30%, or 20% of AGI. Those are the limits. So charitable contributions to public charities, and the IRS has a website that lists qualified charities, you can deduct up to 60% of AGI. So again, that AGI number is very important. We want that number, AGI number, to be as low as possible in most cases, but in this case, 60% of AGI would be, if we had a higher AGI number, then that would welcome in more charitable contributions. All right, so if your contribution has to be more than 60% of AGI, then you can carry that unused deduction forward. The 30% of AGI limitation applies to the contribution of contributed capital that has a capital gain. So if you contribute property that, had you sold it instead of donated it, you might have had a capital gain, then the limit is 30% of AGI. That's a little bit low, cut in half. And then finally, there's a 20% of AGI limitation for donations of capital gain property to a private foundation. Most people, their donations would be included under the first bullet point here and would be subject to the 60% of AGI limitation. We talked about appreciated capital gain property to a public charity. There is an exception that concerns the contribution of tangible personal property. If you donate property and it's not put to the related use of the charity, for example, then you may lose the deductibility of that contribution. So, for example, or at least part of the deductibility, if I contributed a painting to an art gallery, and the art gallery, instead of displaying it in their museum, they sold it. As I'll demonstrate later in one of the Connect problems, I might lose all or a good part of that deduction. Matter of fact, the contribution would be reduced by the amount of any long-term capital gain that would have been realized had I sold the property at fair market value. I will demonstrate this concept a little bit later in a Connect problem. So the hope is that if you donate an item to a museum, for example, they're going to display it and use it for its intended purpose. But if they convert it in a way that was not intended and is not consistent with their mission or the purpose of the charity, then the person who donated the property may not get the entire deduction. They may lose out on a good part of that contribution deduction. All right, so there are some limitations here in terms of the documentation that you need. If the IRS audits you, generally if you donate less than $250, all you need is a canceled check or receipt. If it's greater than or equal to $250, you must receive written acknowledgement from the donee, whoever you donated it to. As I said earlier, unused contributions can be carried forward. I didn't mention up to 5 years, but that is the limit now, and it's been that way for quite a while, as a matter of fact. So contributions above your prescribed limit set forth back here may be carried forward for up to 5 years to offset future adjusted gross income. If you suffer a casualty and theft loss, the Tax Cut and Jobs Act of 2017 made a significant reduction in our ability to deduct casualty and theft losses. So now, in order to be deductible, a personal casualty must be a declared federal disaster. So it has to be a federally declared disaster, and this can only be so designated by the President. Otherwise, personal casualty losses are no longer deductible. If you have insurance coverage and you recover some of the loss, then of course that would reduce the amount of your deduction. So casualty losses are usually the lesser of the fair market value immediately before the casualty, reduced by the fair market value after the casualty. I'll be demonstrating these concepts as well. Deductible limit is first reduced by $100 per event. And then the loss is subject to a 10% of AGI threshold. So anything above 10% of AGI after you've taken out the $100, it may be deductible. And we report this on Form 4684. There are some other itemized deductions that have built-in thresholds or AGI limitations. Some of the common itemized deductions, if you have gambling losses, Generally, you cannot deduct just the loss itself, but any winnings can be offset by these losses. I'm going to move over a little bit to the problems you have in Connect, as I said earlier. One of the problems you'll see in Connect is Adrienne contributed an antique vase. She owned for 25 years to a museum. At the time of the donation, the vase had a value of $35,000. The museum displayed the vase in the art gallery. That's good, and because then the donor may take the full deduction. So what is a deduction? Well, assume that Adrienne's AGI is $80,000. Her basis, or maybe her cost of the vase, was $15,000. How much can she deduct? As you're calculating this, please note in Part A that you'd compare the fair market value to 30% limitation, not the 60%, because this is capital gain property. So please compare the fair market value of the vase, $35,000, to 30% of her $80,000 limitation, and take the lesser of the two. All right, the lesser of 30% of $80,000 or the fair market value of $35,000. Now let's go to Part B. Part B says, would your answer to Part A change if instead of displaying the vase, the museum sold the vase to an antique dealer? Absolutely, because now, as I said earlier in the PowerPoints, the museum is not using it for its intended purpose. A couple of changes here when you do your calculation. The percentage actually goes up from 30% to 60%, which is a good thing. However, you'll be comparing the 60% of AGI to the basis of the property and taking the lesser of the two, not to the fair market value. So it's stepped down to the basis because the museum did not use the vase, the donation, for its intended purpose. So here's a couple of notes then that relate to how the museum used the donated asset. Okay? Finally, in Connect, you have a problem here where we have a cottage that was damaged by an earthquake. It was a presidentially declared disaster area, so it looks like some of this can be deductible. So we look at the details. They had an AGI of $110,000 in 2019. The following is information related to the cottage. They give you the cost basis, what the taxpayer had into the property, fair market value before the casualty, the fair market value after the casualty. So what I would do is take the difference between these two, $115,000, and then you're going to compare the $115,000 to the $95,000. You take the lesser of the two. So now we'd be focusing on the $95,000, and then they received $80,000 of insurance proceeds. So you're going to take that $80,000, since that was recovery of your loss, and you're going to net it against the $95,000. $80,000 against the $95,000, and that will be the amount of your deduction. So a couple of steps here. First, take the difference between the before fair market value and the after, a loss of $115,000. Compare that to your basis in the property of $95,000. Take the lesser of the two, and then deduct your insurance proceeds. And that's your loss that you can deduct. And this is, of course, before we consider that $100 and the AGI limitation. This is before any of that. So that's a summary then of some of the problems you have in Connect, as well as the major concepts in Chapter 5. If you have any questions on these or other concepts, please let me know.